Hey, everybody. It's Friday, and you know what that means. That's right, we are back from our Christmas vacation. It is the Real Deal Pod with Allister and Geoff. It is episode 82. And that is right, it is me, your trusted realtor, Allister Carrington, alongside our main man, our trusted mortgage broker, Geoff Lee. Woo, it is sunny outside. It's gonna be plus 10. It's a beautiful day, and I'm so happy to be back. Geoff, buddy, how you doing? How was your Christmas?
You know, my Christmas was great. My New Year's was great. I partied like it was 2019 or whatever Prince's song is.
1999?
Yeah, that was close. Party like it was 1999. And then came out of it saying, you know what? Don't want to party like 1999 anymore. I'm just getting a little bit too old for that. But yeah, we're deep into January already, and it just feels like this train is moving.
Yeah, it's crazy. I had a good Christmas too, but same. I barely made it to New Year's to 12 o'clock. I'm not gonna lie. I forced myself to stay up. It was the kids keeping me up to say Happy New Year more than my body. My body just wanted to go to bed at 11. It was done. It was tired. But had a great New Year's with the family. And like you said, I apologize for not being able to do the show last week. It's already kicking off pretty busy for me. So, and I'm gonna kind of talk to that later on. But yeah, it seems to be a busier January than normal, which is nice.
Day to day,
Nice.
month to month.
Right? That's how we live. That's how our industry lives. Awesome. Well, hey man, I know we got a lot to talk about, so let's kick it. Let's kick it off right with the hottest segment in podcast, and that is
Did you
that's right,
know?
baby. This week's Did You Know and Insights with Alistair are all going to be combined because I wanted to sort of give a little summary of what we went through in 2025 and what we can expect a little bit going forward into 2026 because Royal LePage and Remax have they've given their outlook for 2026 and they both sound the same, which is great. It means that both companies are in lockstep, and it sounds interesting for our buyers and our sellers moving forward. So let's get into it. So did you know, and I know you know, Geoff, but 2025 wasn't just slow. It was structurally different from anything the Fraser Valley and Metro Vancouver has experienced in more than 20 years. It wasn't a market held back by a lack of opportunity. In fact, buyers had more choice than at any point in nearly 4 decades. We had new listings that surged, inventory stayed elevated, prices continued to trend downwards, finishing the year roughly 6% lower than 2024 and more than 20% off the 2022 peak. So that's where prices dropped, more than 20% than the peak of 2022 and
Can you
6% lower than last year.
can you say that again just for people
Yeah,
that basically got distracted?
you betcha. Prices continued to trend downward, finishing the year roughly 6% lower than 2024 and more than 20% off the 2022 peak.
Yeah. Yeah.
Yeah, and in fact, I'll take it even one step further. When you adjust for inflation, we were lower than 2017.
Well, someone, and I believe it may have been you, said to me that this is the second worst market
Yeah,
that our country, or well, I won't say today, 2025 was the
yeah.
second worst market that our country has ever seen.
That is what I had said to you. Yes, Geoff. Yes, the second worst market to 1980. And that's the crash that everybody fondly talks about. They love to talk about that. Well, now our children won't be talking about the crash of 1980. They'll be talking about the crash of 2025.
And I know I just want to just jump in on something, and I can guarantee you the people that went through that crash in 1980, 10 years past that crash in 1990, I can guarantee you those guys said, shit, I wish I would have bought a house.
100%. Every one of them does. My dad does. My dad still says that when we talk. So that's it. And so, so with that drop, with all of those factors that we had that were on the buyer's side to purchase in 2025, sales still fell dramatically, over 30% below the 10-year average.
Yeah.
So with all of that opportunity that we had last year, that buyers had last year, that buyers had been begging for God, over since what, 2018, 2019, buyers have been begging for the opportunity to negotiate, for the opportunity to have a collapse, for this, that, and the other. Sales still fell over 30% below the 10-year average.
Yeah.
Yeah.
And again, I believe that's as awful as it sounds, it's people follow the person in front of them, right?
100%. 100%. So what made 2025 unique was that the traditional triggers didn't work. Lower prices, as we said, didn't spark urgency. More inventory didn't create momentum, and negotiating power didn't translate into confidence. Instead, the market became, well, thoughtful, slower, and more deliberate. And by the final month of the year, though, in December, we started to see the market quietly rebalance. New listings pulled back seasonally. The sales to active listings ratio moved back into balanced territory. Price decline, began to moderate, with townhomes showing early signs of resilience compared to detached homes and condos. In other words, 2025 didn't end as a collapse, it ended as a reset. A year where expectations adjusted, a year where speculation faded, and a year where the market worked through excess inventory and recalibrated pricing. So that is what our 2025 ended up as.
Yeah.
So what does 2026 look like? 2026 isn't shaping up to be a comeback year in the traditional sense. It's a transition year, one where the market shifts from recovery mode into something more functional and sustainable. And so the first thing to understand is this: momentum in 2026 will be uneven. Some segments will move faster than others. Entry-level homes, well-located townhomes, and practical family housing will see the earliest lift in activity. These are need-based purchases, and after 2 years of hesitation, demand here doesn't disappear, it accumulates. At the same time, higher-end properties, luxury homes, and investor-driven condos will likely remain more selective. Buyers in these categories are still cautious, still analytical, and still focused on value over emotion. And so here's the kicker on the condo market for everybody listening. It is still set to drop 3 to 5% this year.
Can I jump in, or are you?
Yes.
Are
No,
you
go
on
ahead.
board?
Go ahead.
I think it's important to understand and explain to our audience as far as why, right?
Because there's so much of it.
Exactly.
There's so much excess inventory in the investor-driven condos. And so those already took a drop of 4 to 6 it was, in depending on the area, 4 to 6 this year, right? It's supposed to drop another 3 to 5 this upcoming year.
So again, folks, like Allister's dad
Yeah.
back in 1980,
Yeah.
I wish I would have bought a place. If you are in the condo market,
Yeah.
2026 is the year for you.
100%.
Don't be that person that you're following in front of you where they're walking in fear.
Yeah.
Be that, take the right turn, get in front of that person, allow them to follow you, and that's going to initiate people starting to jump back into this market.
For sure. But it's not just the condos. Don't forget entry-level homes, right? That is supposed to see an uptick this year, as well as located townhomes, right? Those are the segments, especially that are supposed to drive, that are driving as I'm experiencing with my clients, right? The early part of this year of January, and they're supposed to play a huge factor going into spring of this year,
So
right?
what I'm hearing from you, Alistair, is that the
Yeah.
condo market is going to continue to correct,
Correct. Yeah.
or some of us may say suck.
Yeah.
But the townhomes and entry-level homes are going to basically be on the move.
Yeah, and practical family housing,
What does
right?
that mean?
So practical family housing are ones well, they're almost all of our single detached homes. It's the category that's not the 1.25 million, let's say, that's now pretty much your average cost of an entry level single family home.
Okay.
They're in the levels of the 1.4 million, where you still have that basement suite, might have a coach house, so now you're generating income for yourself while you're still living in the main house. It's the category just underneath the luxury homes. Yeah, yeah, yeah. So the other thing, guys, interest rate stability will quietly do the heavy lifting. So it won't create a surge, but it will remove paralysis. Buyers in 2026 will stop asking, what if rate drops again?
Yeah.
And start asking, can this work for us long term? That shift alone brings more consistent and predictable activity into the market. Inventory will also continue to play a role, pardon me. Healthy supply means buyers will stay patient. Days on market will remain longer than pre-2022 norms. So again, we're not going to go into this 7 days on market being the 7 days on market or 14 days on market environment. Still expect to see 30 to 40 days on market as your average sale. Maybe we might drop as low as 21, but again, don't fall into this homes are going to be on the market for a week type of deal that we used to see pre-2022.
Important for people to listen is that if it's priced properly.
Right, and that's the other thing that I was going to get into. Pricing will need to be precise. So sellers who treat 2026 like a 2021 market will struggle, right? That's what they felt in 2025, right? But for those who understand the environment, there's opportunity because balanced markets reward preparation. So expect, pardon me, price movement to be modest. Some areas may see small gains, other areas may remain flat, and some segments could still experience light downward pressure. The key point is that sharp swings or up and down become less likely as our market finds equilibrium. So we're going to see markets that appreciate. We're going to see markets that stay flat. We're going to see markets that still trend downward. The key to all of it is understand the market you're in and be realistic in your pricing.
Yeah. And even
Right.
to touch on the rates is most economists believe for our variable rate for this year is going to pretty much remain where it's at. It might dip a quarter of a point, but it isn't going to be moving like it has been in 2025. So to your
Yeah.
point, rates are stabilizing. It's not going to be the question anymore as far as, I'm waiting for the rates to drop. I think rates are kind of where they're going to be, and the expectation is going to with economists is that where we're at now is roughly where we're going to stay, and you're going to see some fluctuation up, some fluctuation down, but nothing that's going to be hair raising.
Yeah, exactly. That's one of the things that I heard is that we could basically we could almost foresee the rate that we have now being the rate that we have all through 2026. That was one of the reports that I was reading is we could see that.
Yeah.
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 So lastly, guys, and importantly, more decisions this year will be driven by life stages rather than speculation. And that's a sign of a healthier market, even if it feels quieter than past booms. So if 2025 was about recalibration, 2026 is about execution, understanding value, matching expectations to reality, and making decisions that hold up 5 or 10 years from now. It's not about a loud return to the market, it's the steady one. And that, everybody, is the did you know, the insights from Allister, and what we can expect in 2026.
Yeah. I think again, if we even go back to our January 2025 as far as what the outcast was, and what the outcast wasn't really what actually
Happened.
happened.
Yeah.
When we take a look back as far as, these were the 2025 forecasts. 2025 has ended, and what was forecasted to what actually happens, probably very, very different, right?
100%.
And even with 2026, I'm just, for me, it's just, and we talked about this a little bit before we jumped on. Um, I think 2026 and anything really moving forward or even in the past is what you put in is what you're going to get out. That could be your personal goals, that could be your business goals, that could even be like if you're a borrower or a seller or an investor. Yeah, we can always have that excuse as far as, hey, this is where the market's at, this is where this is at, this is the reason why I'm doing what I'm doing. But at the end of the day, what we put in is what we're going to get out. If you put in shitty work, you're going to get a shitty result. If you put in good work, you're going to get a good result, regardless of what's going on around you. I, for me, I firmly believe that.
Oh, I'm a big believer of that. I'm a big believer of that. And I'm a big believer too of, again, when we talk about it, having your power team and really listening to them. This is the time now to really make sure that you have that tight power team around you that understands the environment, because that is really what's going to dictate your success in 2026.
Mhm.
Right. And again, that's whether it's work, right? If you have a mentor, right? Make sure they're a good mentor, right? That gives you the right advice. And for goodness sakes, take it this year,
Yeah.
if not any other year, take it this year. And
And
if you're looking at selling, right? If you're looking at buying, make sure you have the right place, the right people advising you, the right people advocating for you. And if they're giving you advice, make sure you take it, because that's going to determine a lot of your success this year,
yeah.
because we're not going to see those crazy swings.
And remember, folks, your power team is a great mentor. Your
Yeah.
power team is a great realtor. Your power team is a great lending partner. Your power team is a great accountant. And your power team is a fantastic financial planner, right? So understand the components of your power team.
100%. Well said. Well
All
said.
right. Well, let me jump into a three-part series. So
Oh,
again,
right.
this is the first pod that we're going to do on this, and then we're going to do two others. And I want to basically start talking about three mortgage mistakes that Canadians are making or will make in 2026. And if you are a homeowner, how we can save or how you can save thousands and thousands of dollars by simply avoiding these mistakes. And there's three, Allister. Today we're going
Okay.
to talk about one. Are you ready
Okay.
for it?
Let's go.
These are some things that people need to understand. In 2026, there is over 1 million mortgages that are going to renew. Crazy.
Yeah.
These mortgages that are renewing, people are going to be paying up to 3% higher than what they're paying now. That's the reality. And what we need to understand as a country, we are at the highest level of consumer debt that our country has ever seen, of $2.5 trillion.
That's a lot.
That's a lot. So the mistakes that we are going to cover that Canadians are making in 2026, and probably 2024, 2023, 2022. But since we're talking about 2026, the three mistakes we're going to cover is mistake number one is called the loyalty tax. And the loyalty tax is for those whose mortgages are coming up for renewal in 2026. And remember, we just talked about this. There's over 1 million. Mistake number two, which is we're going to cover next week, is called the cash flow leak. And what that means is that if you have consumer debt, what are you doing with that consumer debt? And what does that mean to you out of pocket? And the third one is the options myth, as far as what you believe what your options are. Is it myth or is it fact? This week, we're going to talk about the loyalty tax. And basically, what the loyalty tax is all about is that your mortgages are coming up for renewal. Some of us who are listening, your mortgage may have already come up for renewal. And now we're thinking in hindsight, and you're like, geez, I wish I would have listened to this pod before my mortgage renewed. But this is for the 1 million plus people that mortgages are renewing here in 2026. And let's start with this. The most expensive mistake that people are making, according to a Rate Hub study in 2025, is that one mistake will cost the average Canadian, and we're going to talk about this, about $14,000 over the course of 5 years. And what is that mistake? We call it the loyalty tax, and that means people are auto-renewing their mortgage without comparing options.
That doesn't surprise me. We talked about this before.
Exactly. So again, typically if your mortgage is coming up for renewal, here's what you're typically going to be experiencing. First thing is you get a renewal letter from your bank. Okay. And typically that's 30 days before the renewal. And the reason why you're getting that 30 days before is because it doesn't really give you a lot of option to shop around if you choose to do so. Right? It looks official. It's official and routine. You're busy with life. You got your kids going to school. You got lunches, breakfasts, and dinners that you got to make. You got laundry that you got to do. You got grass that you got to cut. You're busy. You got work that you're going to. You are busy with your life. So what happens? Most people will just sign it, send it back because it's easy, it's convenient, and it's done. And now you're on to the next thing. But here's the problem. If you accept your lender's opening offer as the final answer, it is costing you about $14,000 over the cost of the 5 years. And here's the reason why. Most mortgage renewals that come from major banks are often up to 1% higher than if you were to shop that renewal around. 1%. Right? So that's a significant amount. So this is about people are being careless. We just talked about, the workflow as far as what that looks. But the reason why people are auto renewing, and we talked about life is busy, renewals just feel routine. How many times have you heard this? My bank loves me. I love my bank. They got my back. You just assume that they're giving you their best rate. It's easy. You don't have to hassle of switching to another lender. Lots of us, Allister, don't even believe that you have an option. They say, hey, I started this thing here at Scotiabank. I guess I'm with Scotiabank forever, right? Or whatever financial institution that looks like. Or you're going through a major life event. Maybe you're going through a divorce. Let's not talk about that. Maybe you're going through a bankruptcy. Maybe you're going through a consumer proposal. Maybe you lost your job, right? Maybe you don't have a choice but to auto renew. So again, and we've talked about this before, and I'm going to quiz you, Allister, and if you don't get the answer to this, you're going to get your knuckles hit with a ruler.
Please don't.
What percentage of Canadians do you think, Allister, auto renew without considering other options? Is it 25%? Is it 45%? Is it 60%? Is it 72%? What do you think?
Well, Regis, I think I'm gonna choose. Wait, did you start at E or start at D or is it
I started at A, 25%,
okay?
B, 45%, C, 60%, D, 72%.
I'm gonna go with D, 72%.
Alistair, is this your final answer?
That's my final answer. I'm locking that in.
All right. Ding-ding-ding-ding-ding. The answer is D, 72%. So here's the
Woohoo!
thing. 7 out of 10 people will automatically renew their mortgage without shopping around. So when we talk a million plus mortgages are renewing in 2026, 720,000 plus of those people are simply going to renew their mortgage with their lender for the reasons that we explained. And 720,000 plus people are going to be paying around $14,000 more than if they shopped that mortgage around.
It's wild.
Should we do the math? Anyone got a calculator? Right? So here's the scenario. Someone has a mortgage balance of 500,000. A bank offers a rate of 4.89%. The monthly payment on that is about $2,877. It's a 5-year term at 25-year amortization. Now, again, if that same owner shopped that mortgage around and just say they got a rate of 3.99% on that $500,000 mortgage, their payment is actually around $2,627 versus $2,877 for those who didn't. Same term, same amortization, and basically when you run the math, that's $250 a month that you'd be saving. That's $3,000 over a course of a year, and that's $15,000 over a 5-year term, right? So important to understand, this is the same house, this is the same family, this is the same income. The only difference here is that you didn't accept the first offer, right? So some of us, and we're going to kind of get into what mistake number 2 is, some of us can even lower the down payment more if you re-amortize the amortization of up to 30 years. And when you do the math on that, if your new payment is $2,375, that's a savings of $502 each month. Alistair, what would you do with an extra $200 to $500 a month?
Oh, for me, I'd invest it.
Right. For others, you're going to pay off bills, like,
Sure.
and others are going to spend it. But $500 a month, that's $6,000 a year. And over a course of 5 years, that's $30,000. So if you could restructure something that's going to save you, or if you're going to restructure your mortgage renew or do a renewal, and you're going to save anywhere from say $15,000 to $30,000, why wouldn't you do it? Why wouldn't you shop it around?
Oh, that's crazy to not. That's wild.
And this is what I'm saying. 720,000 plus Canadians with their mortgages renewing here in 2026 are going to be potentially lose savings of $15,000 to $30,000. And to be honest with you, if we had 100 people on this, or if we have 1,000 people or 100,000 people listening to that pod, that's 70% of the people in our audience right now.
Yeah.
Right?
Yeah.
So here's the thing. Never, ever, ever take the first offer that your bank has given you. Okay? It's an opening offer. It's not the final answer. And I think this is where a lot of people get confused, is that this is what the bank's offered. I guess this is basically what we're going to do. That is not the case. Never take the first offer. Now, again, people will say, well, I'm loyal. How many times, I'm a loyal person, right? The thing is shopping your mortgage, yes, you're going to have to leave the current financial institution that you're in. Shopping your mortgage also is like education. You get a better understanding on what your options are so you can make an educated decision. again, Alistair, if I'm going to say, hey, you can save yourself up to $30,000 by shopping it around, why wouldn't you do that? And why wouldn't you leave your current lender?
Well, that's my point. I was just gonna just that's why I raised my hand. I was gonna say, why are you being loyal to somebody that's stealing $30,000 from you? Like that.
Well, it goes back to the reasons why, which we talked about earlier,
Right. Yeah.
right? So, and shopping it around, folks, it's not a worse, like the worst case scenario is you stay exactly where you are. There's no risk to it. The best case scenario is that you're going to be saving thousands of dollars and get the best mortgage for you, right? So anybody that has a mortgage that's renewing, I have a script that I can send to you guys. Just email me at jeff@glmmortgage.com. It's a 5-question script that you basically will talk to your bank when your mortgages are coming up for renewal to ensure that that rate that they're offering you is going to be the best rate and not their first offer. So if that's you, anybody that you know, give me a ring, give me a call, send me an email, do whatever you need to do to get a hold of me. I will send you this script. And again, this script, by you just doing this one thing, can save you up to 30 grand. And really, this is where we go back to into our pod for next week. Even with a great mortgage rate, Alistair, you can still be bleeding money, right? The mistake that we have to understand, and this is a number one mistake, was about the rate you accept on your mortgage, the first offer. Mistake number two is about the rates you tolerate on everything else, which is going to lead into our next week's pod called the cash flow leak. And what that means is carrying high interest debt when you can consolidate it into your mortgage. So stay tuned, and we'll see you next week and we'll talk about that.
That's beautiful. I have a quick question. Is there a time, like I read a number one time, like how many days out when shopping your mortgage, like you should start shopping your mortgage 120 days before your mortgage renewal like before you have to renew your mortgage. Is that about the right time frame? Is about 120 days?
You can start shopping around for rates and lock into rates depending on the lender that you're shopping around to, anywhere from 90 to 120 days.
Okay. Yeah. 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 No, that's good for everybody. That's good for everybody to know because it's true. Like and so wasn't there a new one of the new mortgage rules? Wasn't that supposed to sort of address the what banks are doing by sort of, stealing your money from you?
I'm not too sure where you're going with that.
No, no. Weren't they supposed to offer you during renewal? Weren't they supposed to offer you the maybe lowest rate, or how were they supposed to address that?
Well, I think what you're referring to is that now a lot of people were kind of staying where they were staying because they couldn't qualify at other lenders, or they believe they couldn't qualify at other lenders because of the stress test.
Stress test, that's right. Never mind.
So what is happening now is that, as per the Bank of Canada guidelines, is that, say, for example, Allister, if you're with RBC and basically Envision Credit Union is able to give you a better rate, and you're not qualifying in the past because you had to qualify based on the stress test. In 2026, you're able to actually qualify on the rate that you're going to be going into. And what that really means is that when you're qualifying on the stress test, that affects the purchase power or your borrowing power roughly about 25%, right? So now you transferring your mortgage from RBC to Envision, you're not qualifying or requalifying on the stress test rate, you're qualifying on the contract rate, right?
Right, that was what it was. Okay.
And now in doing that, again, it's designed for the borrower to be able to shop that mortgage around and be able to get a sharper rate at another financial institution if they need to do so.
Right, okay, that's what it was.
Yeah.
Awesome.
All right,
Awesome.
that's what we got. So stay tuned for next week. And we'll talk about mistake number 2, which is the cash flow leak.
Amazing, man. Well, see, I think that we started off the year pretty darn good with the information that we've provided.
Hey,
Hey,
if somebody is telling you how you can save up to $30,000 in the beginning of the new year
yeah,
and how to
that's
do it, that's pretty good. That's a pretty good gift. That's a
that's
gift.
a great New Year's gift.
My Christmas gift to you for 2026.
Well, we all appreciate it, my man. We all appreciate it. Well, everybody, that's it for this week, man. Stay tuned for next week where we get tip number 2 from Geoff and the insights and the did you knows from me. And I hope, guys, that we did everything we could do last year to give you all the best content that we could give you. Geoff and I have decided that this year we're tripling down. If that's even possible, we're tripling down because, like I was saying in the recap and what we can expect in 2026, we do see the real estate starting to move a little bit already. We know we're going to see it, not going to see it in some areas like condos, right? But we are going to see it in other areas, and not everybody's going to be buying condos. People are going to be buying practical family homes. People are going to be buying townhomes, and people are going to be buying or going to be entering and buying their first home. So really understanding these markets are important.
And also just like say, to your point, you're not going to be seeing this in condos, but here's a great opportunity for people to get into the market by buying these condos.
Exactly. Because what I didn't mention was 2027, and that is when they expect actually the condo market to tick up, is once we get rid of the remaining excess inventory that we have right now. So we're expecting another 3% to 5% drop in pricing, but then in 2027, the expectation is we're going to see the condo market rise. So just to kind of tidy that up, what we expect is a reset and rise in entry-level homes, well-located townhomes, and practical family living. And then in 2027, we'll see the rebound of condos. So if you're looking to buy your first condo, now is absolutely, I know we said it last year, but this is actually probably the best time you're going to see.
And I want to even break it into a simpler thing, right?
Yeah.
Because I work in a kindergarten mind.
Yeah.
The reason why we have price declines in the condo market is because we have so many of them that are vacant.
Yeah.
If you take a look at development, even development with these condos going up, they're actually not going for resale. They're not selling to the general public. They're turning them into rental buildings.
Purpose-built rentals. Yeah.
Purpose-built rentals. Also, development is slowing right down. So what that means is development was on a tear for the last 3 years. Everybody was developing, everybody was building. We hit this market with the softening market. You're getting these developers now that are converting these resale, like I'm going to sell these to the public, converting them to like shit. There's no sales going on. We have a building that's going to complete. How can we basically make our money? So they're going to convert these into rental buildings.
Yeah.
And as soon as that supply starts to dwindle, and now they're not developing as much. Now, as that supply develop or slows down, or as that development now slows down, and as buyers and people are still going to buy condos. It's not like people aren't buying condos. People who are smart are going to buy condos in 2026 because they're getting Boxing Day sale prices, right?
Yep.
But
100%.
as that inventory shrinks, guess what happens to the demand? The demand rises.
Yep.
And the expectation for that inventory to shrink is between 2027 and 2028, actually, in my understanding, is when you're really going to start to see that condo market correct, right?
Yep.
Because there's not going to be any supply, and that demand is now going to be there. And when you don't have the supply and you have the demand, and we just went through this with the cost of living, what happens to the prices?
They rise, and that's what we faced. And that's, guys, what the environment that we've been in for, my God, again, since 2020. That's that's what we faced all throughout COVID and just coming out of COVID. That's what we faced was lack of inventory and the demand for purchase, and that's what was driving the prices higher and higher. Not to mention interest rates and giving away free money, but that was really the catalyst, was lack of inventory.
Yeah.
Now that we had inventory, nobody wanted to buy. And so that is all now again resetting itself, and we already now again the beginning of January starting to see coming out of December, where we started to see things leveling off. We're starting to see increased buyer activity in January. So if you are thinking of making a move this year, this is the time to get your power team together and start your planning of what your 2026 is going to look like. So
yeah.
That's it for us, guys. Again, thank you so much for taking the time to listen to us. Geoff and I, as I said, are tripling down this year on making sure you guys get the best content that you can possibly get, the best content that we can possibly deliver. Have an amazing weekend. It is supposed to be sunny. We spent a whole lot of time in the dark, rain, and the clouds. So everybody enjoy this weekend because it's supposed to be sunny and warm everywhere. In the meantime, continue to love, like us, share us, tell everybody that you know about us. But most importantly, stay empowered, stay informed. And Geoff?
Stay tuned.
That's right, baby. Stay tuned. Peace out.